Good evening, all. It's Sunday night. Hope you had a great weekend. This is Shay Horowitz, ShogunTrading.com. This is our free weekly newsletter. We started sending it back out because there's so much turmoil in the market that a lot of people want to see it, and we're getting a lot of requests for it, so that's why we're sending it out. Anyway, S&P 500. S&P 500 broke that 800, all important 800 support level, and right around Valentine's Day, which is very cute, and came down. And if you count the waves, you got one, two, three, and now we're going over here. Basically, you have three, maybe four waves if you don't really count this as a wave. That's basically as much as downtrends generate. Now, are we still in a major downtrend? Yes, we are. Are we ready to bounce because price versus earnings ratio looks great right now? Or as some people say, profit earnings ratio? Well, no, I don't think we are. And here's the reason why. We're going to go into a daily chart and bring your kids over to the screen and see what kind of trend we're in. We are in a downtrend. It's a very major downtrend, and it looks pretty bad. Here's the 200-day moving average, was the red line. You have the blue line, which is the 50-day moving average, and then the yellow, which is the 21. You see how they're staggered. You see how far away we are from the red line. We are not going to bounce straight back up. It's going to be impossible. Now, a lot of people are buying, and they're buying, and they're buying, and they're buying, and they're looking for the blue light specials. They're looking for dollar stocks. Do not buy the dollar stocks. Do not buy the junk. If a stock is sitting at $1, there's a reason why a stock is sitting at $1. You are not a bargain shopper. You are not looking for. You're not shopping in garage sales. It's not what you want. You want something that's going to go up. You don't want something that's just going to be junk that you're going to sell in the next garage sale. If you buy something at a garage sale, sometimes you have to sell it back in your next garage sale. It does not work. You want to buy something that you know is going to go up. Now, when are we going to know that the market is going to go up? The market is going to go up when the buyers become more aggressive than the sellers. That's the only thing that makes the stock market go up, when the buyers are more aggressive than the sellers. So think about it this way. What would cause buyers right now to be more aggressive than the sellers? Right now, the sellers are very aggressive because people want out. People are liquidating. People want out. People are liquidating their mutual funds, liquidating their stock accounts. They just want out. So when are buyers going to be more aggressive than the sellers? They are when, first of all, the market stops diving. The market needs to take a break first so they feel safe. So we're not going to bounce straight back up. We're going to need some kind of a sideways movement first so they feel safe. Okay, we're taking a break. The market is calm. No problem. It's safe to get back in the water. That's one thing. Second of all, they need some kind of optimism. They need to know that if they buy a stock right now, there's favorable market conditions and the stock is going to go up. And frankly, myself, I don't really see it right now. It's not. There's not much positive out there. There's not much that's telling me that people are really ready to go out and do business. So, and that's a global situation at this point, and frankly, the administration is not doing much to encourage investors to go out and risk their capital on investing in new business. It's just not. So that's one of the reasons why the market is coming down. Now, there's one more thing that I have to say is forget about the day-to-day gyrations of the market. I've never heard anything that bad about the stock market. These are not day-to-day gyrations. Here's a monthly chart, and you cannot tell me that these are day-to-day gyrations, and you can't follow them because they don't matter. They matter a lot. This is serious. We went from the 1500 down to 683, 666 actually, which is pretty ironic. And these are not day-to-day gyrations. These are decade gyrations, really. And it's very, very important because the market is really an indication of how people are feeling. Whether people are feeling confident to invest, they're feeling confident in the future, as in investing in the futures, or they don't feel comfortable and they're pulling back. So I don't agree with that at all. Now, the whole philosophy of just buy and hold does not work anymore. The market just doesn't work that way. The market needs trading. And even if you look at a monthly chart, this is the simplest technical analysis out there. Here's a double top. You can see one top, two top. Market goes down. Here's a bottom and a higher bottom. Market goes up. Here's one top, to top, and the market goes down. That's what matters, and that's what traders do. Traders enter when there's a bottom, and they exit when there's a top, or they go short where there's a top and cover where there's a bottom. I don't see any signs right now of a bottom on a long-term basis on the S&P 500. Become a trader. Take control over your investments so you are not caught in this buy and hold attitude. And by the way, I used to be a stockbroker a long time ago. I was trained as a stockbroker, and one of the stockbroker's favorite strategies is scaling. Basically, scaling. It's not really scaling it. It's dollar cost averaging. Basically means that if the stock is diving, if you liked it at 50, you're gonna love it at 25. You're gonna love it twice as much at 25? No, there's a reason why the stock went from 50 to 25. If the stock goes down to 5, are you going to love it 10 times as much? No, something changed. People's attitude about the stock changed. Here's Citibank. Here's an example of Citibank. Citibank went from 55 down to $1. Does that mean that at $1 you have to like Citibank 55 times as much? No, it does not. It means there's something fundamentally wrong with the stock, and they might wipe out equity. They might nationalize the bank, and therefore your stock is going to be worth nothing. You might as well use it as wallpaper. If you believe what you see, and you're seeing the stock coming down, there's something wrong. If you believe what you think, remember that our thoughts can be influenced by our emotions. Our thoughts can be influenced by the media. You do not want to believe what you think. You want to believe what you see. What you can touch. And over here, Citibank is a perfect example of knowing that, hey, the stock is going down. I don't care how much they say that they're doing well. The stock is going down. Remember the Bear Stearns and Washington, Wachovia, Washington Mutual, Lehman, all those guys came on CNBC a few days before they fell apart, and they said, we're doing fine. Everything looks great. And that's exactly what Citibank is coming out and saying right now. So listen to yourself. Look at the market. Here's back at S&P 500, Dow Jones Industrial Average, and you can tell there's something wrong. And until we get this kind of a bottom, 1, 2, I would not enter. And the beautiful part behind this pattern of the double bottom is that a lot of people are going to think that they missed the bottom. A lot of people are going to say, I don't want to miss the bottom. I'm going to buy every dollar down. I'm going to dollar cost average. I'm going to start buying Citibank at $1 because they're afraid of missing the rise. No, you are so much safer waiting for the second bottom. Here's another one let me go back to S&P 500 real quick. And those that try to guess the bottom, they try to guess the bottom, they try to guess the bottom, they try to guess the bottom, try to guess the bottom. Oh, and they finally got a little bit of a rise. But you know what? They were buying all the way down. That didn't make up for it. Those that were patient and didn't try to catch the first move, waited for it to pull back down again, waited for the higher bottom, and then they enjoyed a very, very nice trend up. Now, I'm going to keep you up to date. I'm going to try and help you out with this. Anyway, it is what it is until it isn't. This is the market. This is the economy. Don't believe the talking heads. Look at it yourself. Know exactly what you're going against. Be more practical about it, and you'll be so much better off. Do not listen to the talking heads. Do not listen to the politicians. The politicians have an agenda. These are not the day-to-day gyrations of the market. This is serious. This is your money. This is your retirement, and so on. Anyway, I'm coming up with a new book. The new book is going to be about how to use the Zen philosophy, the samurai philosophy, to control your emotions while you're trading. We are going to give it away for free to all of our current subscribers right now. These are the paid subscribers, not the free subscribers. As basically as a research, we want the feedback. So if you want the book for free, you know what to do. Have a great night, and I'll talk to you next week. Take care.